For the first time in February 2020, the Reserve Bank of India introduced long-term lending to banks. What are the circumstances which led to its introduction? Where do we stand now after a series of events, such as TLTRO on-tap TLTRO? Welcome to InvestorZilla, your destination for financial education, investment analysis, and economy indicators. Subscribe to this channel for more such videos. What is repo? Banks borrow from the Reserve Bank to meet short-term demands. This is usually done using something called as the repurchase agreement or repo. A repo is a form of short-term borrowing for banks, often for a maximum period of 28 days. However, the Reserve Bank requires a collateral for the amount of funds lent to the banks. Banks use government securities or G-SECs as a collateral for borrowing funds using repo. Banks often invest in G-SECs or treasury bonds which are issued by the government. They are deemed to be the safest mode of investment. The Government of India guarantees its redemption. These investments are over the mandated regulatory investments that the RBI requires. A bank sells government securities to the Reserve Bank. It gets the required funds in exchange. It agrees to buy the securities back from the Reserve Bank by returning the borrowed money along with an interest in a short period, which is a maximum of 28 days. This interest is specified by a rate known as the repo rate. What is LTRO? Repos that have a specified maturity date, usually the following day or week, are called term repurchase agreements. The Reserve Bank wants the banks to keep the funds for a longer duration so that they can provide long-term loans to companies seeking investments for expanding their operations, hence the name long-term repo operation or LTRO. Under this arrangement, banks can borrow the funds for 1 to 3 years at the repo rate. This is a source of cheap funds for the bank. They can then lend the same funds at a higher interest rate to companies. The difference in rates adding to their income. Banks can also invest these long-term funds in assets that yield better returns to improve profitability. Securities like commercial papers or corporate bonds of other companies. The companies use these funds to produce goods and services which are consumed by the population, leading to a greater economic growth. At the time of repurchase, the bank pays a higher buyback price for the securities. This is the result of the interest the Reserve Bank charges for providing the money to the bank using this repo rate. The bank provides the borrowed money with the interest, receives back the G-SECs, and the transaction is now closed. Why the LTRO now? When banks lend out money, they depend on the cash flow generated by the interest payments to lend further loans. One such company which many banks lent or invested in was a major non-banking financing company, or NBFC, called Infrastructure Leasing and Financial Services, and its group companies. This NBFC enjoyed AAA rating by rating agencies on its debt instruments such as commercial papers. This helped IL&FS in securing easy loans from the banks. In the case of loans, the company's properties were not mortgaged, as it simply provided commercial papers, which is an unsecured debt instrument issued by a company for borrowing money. As public sector institutions such as SBI and LIC held large shares of the company, the market trusted it. Mutual funds had also invested in this company. IL&FS committed a series of defaults starting in September 2018. This caused a major disruption in the cash flows, as this affected the liquidity of the bank, and banks had less money to lend to. Sadly, within a week of default, the rating agencies such as CARE and ICRA downgraded the credit rating of IL&FS instruments to default or junk status. This downgrade and default on some other financial instruments results in a massive sell-off in shares of every NBFC on the market, fearing such risks. Mutual funds which had invested heavily on NBFC and their financial instruments faced a redemption of their investments. This adversely impacted sentiment in the debt markets. This created a large systemic risk, leading to good quality debt instruments being sold at steep discounts to meet redemption demand for investors looking to exit IL&FS instruments. Banks had lesser cash to lend. This affected their lending to other sectors as banks became more cautious, leading to a liquidity crisis. Thus, in order to pull the economy out of the gloom, RBI had eased the policy at many levels and slashed repo rates by almost 139 basis points during multiple monetary policy reviews between February and December 2019. As these are short-term funds that need to be paid back within 28 days, and since the liquidity is also affected, banks haven't been able to lend out long-term loans. Banks cited the lack of liquidity as a reason to not reduce the interest rates on these existing loans by a significant margin. Hence, in Feb 2020, for the very first time, RBI announced LTRO to increase the proportion of low-cost funds with banks. RBI conducted LTRO operations at the tune of 1 lakh crore in February and March 2020 in 4 tranches of 25,000 crore each. This operation was fully subscribed by the banks, who accessed these funds at the prevailing repo rate at the moment. This was expected to address the liquidity issue with the banks and allow banks to lend out long-term loans at cheaper rates. What is TLTRO? In the context of the COVID-19 resulting in reduced business activity and job losses, investors made large sell-offs in the domestic equity, bond and forex markets. This has led to higher yield or liquidity premium instruments such as corporate bonds, commercial paper and debentures, as investors wanted a higher rate of interest to invest in riskier businesses during the pandemic. As corporates found it difficult to raise working capital, this resulted in more job losses. While the LTROs address the issue of liquidity with the banks and availability of low-cost funds which they can lend out at a cheaper rate, RBI introduced TLTROs to address the issue of availability of working capital for the corporates. It is called targeted LTROs. Banks opting for funds under this option had to specifically invested in investment-grade corporate debt, thus putting the money in the hands of the corporates. The RBI conducted TLTRO operations at the tune of 1 lakh crore from March 2020 to April 2020 in 4 tranches of 25,000 crore each. This issue was subscribed completely by the banks, who used the money to mostly invest in corporate debt instruments, which were rated AAA. Banks were given 30 days to deploy the funds. What is TLTRO 2.0? The disruptions caused by COVID-19 have, however, more severely impacted small and mid-sized corporations, including NBFCs and microfinance institutions, in terms of access to liquidity. Many NBFCs lend to the informal sector, which has been hit the hardest. RBI has offered payment moratorium to all borrowers, even of NBFCs, which means many such people will not pay their monthly dues. Banks had refused to allow NBFCs any moratorium, so NBFCs still had to pay the banks as much as they've borrowed. Now these companies will need to either pay from their cash reserves or borrow using their debt instruments. The bond and money markets are hurting major players, such as mutual funds backing away because of redemptions. As part of the second COVID-19 rescue package, and specifically to ease liquidity for NBFCs, the RBI on April 2020 also announced TLTRO 2.0 worth an initial amount of 50,000 crore in 2 tranches of 25,000 crore each. Banks were given 45 days to deploy the funds. The funds availed by banks under TLTRO 2.0 should be invested in investment-grade bonds, commercial paper, and non-convertible debentures of NBFCs or microfinance institutions only, with at least 50% of the total amount availed going to small and mid-sized players in the market. Unlike the TLTRO 1.0, this issue was not subscribed completely, as banks only bid for 12,500 crore out of the 50,000 crore up for grabs. Banks were risk-averse, and though they could profit, they did not want to risk deploying the capital in bonds of riskier companies. In addition to announcing TLTRO 2.0, RBI has also created a special 50,000 crore corpus to enable National Bank for Agriculture in Rural Development NABARD, Small Industries Development Bank of India SIDBI and National Housing Bank NHB to meet the sectoral needs through refinance. The bid was to receive 25,000 crore for refinancing regional rural banks, cooperative banks and microfinance institutions, while SIDBI will get 15,000 crore and NHB 10,000 crore for supporting their respective sectors. What is on-tap TLTRO? The on-tap TLTRO comes in the backdrop of bank credit offtake being low during the first half of fiscal year 2021. The Reserve Bank in October 2020 announced an on-tap targeted long-term repo operation scheme of up to Rs 1 lakh crore to enable banks to provide liquidity support to a host of sectors, including agriculture, retail, pharmaceuticals, and SMEs. Under this initiative, banks can approach the Reserve Bank for any fund requirements. The Reserve Bank will be aggregating all requests received from the banks for the funds and release funds every Monday by initiating a 3-year repo contract with the requesting bank. Multiple requests by a bank in a week will be clubbed into a single repo contract. Liquidity availed by banks under the scheme has to be deployed in corporate bonds, commercial paper, and non-convertible debentures issued by entities in sectors like agriculture, agri-infrastructure, retail, and SMEs, pharmaceuticals, and healthcare over and above the outstanding level of their investments in such instruments as on September. The liquidity availed under the scheme can also be used to extend bank loans and advances to these sectors. The scheme will remain operational from October 22, 2020 till March 31, 2021, or until the funds have been availed. It is expected that it will lower the corporate bond yields, thus lowering the cost of capital for the NBFCs. Some key conditions exist. If a bank fails to deploy funds within the specified time frame of 45 days, the interest rate on undeployed funds will increase to prevailing policy repo rate plus 200 basis points for the number of days such funds remain undeployed. This incremental interest will have to be paid along with regular interest at the time of maturity. Investments made by banks under this facility can be labelled as held to maturity even an extra of 25% of the entire funding allowed to be included within the HTM portfolio. Held to maturity investments are debt instruments invested by the bank which it intends to hold till maturity. All exposures under this facility will also be exempted from reckoning under the large exposure framework, and EF indicates the maximum exposure that a bank can have to securities of a counterparty. For example, a bank could have an exposure to securities of a corporate to only 25% of its capital base. Any purchases done using the on-tap TLTRO would not be under consideration of the LEF. Banks that had availed themselves of funds earlier under targeted long-term repo operations were given the option of reversing these transactions before maturity. By exercising the option of reversing LTRO transactions before maturity, banks can reduce their cost of funds as the policy repo rate has come down. The targeted lending operations haven't been completely successful. Banks have complained of less venues to deploy funds. Concerns over credit quality and capital constraints have kept bank credit growth slow, even though funds raised through corporate debt have surged. The Reserve Bank's action on TLTROs may be good to create liquidity for some NBFCs, but the system itself is weak and it may eventually need the RBI itself to step up and take some of the risk, such as buying corporate bonds themselves. This is something that is already done by the central banks of the US and the Eurozone, and it could only be a matter of time before the Reserve Bank of India also does the same. However, the Reserve Bank of India has said that they are not looking to buy corporate debts. So for now, we have the TLTROs. If you like this video, hit the thumbs up button and subscribe to this channel for more such videos.